Hello everyone, this is Ben with Income Options Trading, and today I wanted to go over the expected annualized return using tastytrade mechanics. I've gotten a lot of questions recently about returns on various strategies, so figured I'd do a short video here and first do more of a generalized video using tastytrade mechanics, which is a lot of short volatility delta neutral trades. So now I'm just going to go over some of the tastytrade mechanics. If you've watched tastytrade for some time, this should be familiar to you. If not, this will be new information. I do recommend you check out tastytrade.com for additional videos and supplemental information from what I have here, but this is just a starting point. So tastytrade mechanics here, first off, we're going to start with short strangles, open 30 to 60 days to expiration, about 20 delta on the short options, and typically SPY is used as the benchmark. For management, they do manage at 21 days to expiration or 50% profit, whatever comes first. And for most of their studies, they close and open a new strangle with the above criteria at 30 to 60 DTE with the 20 delta short options. You can also roll up and down the untested side of a strangle when a position reaches a certain delta. A lot of their studies, they don't involve that, since it's kind of up to you on when you roll. And they've also done studies showing that closing the strangles at 2x loss gives you about the same return as managing at 21 days to expiration. So then another tastytrade mechanic is getting a minimum credit of 10% of the buying power reduction. So if you take in $1, you shouldn't be using more than $1,000 of buying power reduction. Typical is 15%. You can get as high as 20-30%, but on average it's usually around 15%. And then they also have maximum portfolio allocation based on VIX levels. So if the VIX is a certain level, they have different criteria for how much capital to put into trades. And this is to avoid volatility expansion and blowing up your account. Per tastytrade research, expect to keep 25% of your extrinsic premium. This is kind of the basis of the calculation for your annualized return. So with the 50% profit or 21 DTE, they've done research and you keep about 25% of your premium. And so for short strangles, your extrinsic premium is simply your credit received. So here is their table for the portfolio allocation based on VIX levels. The normal account allocation, that's for sure for accounts above 100,000. If you're in the smaller account, around 5,000, 10,000, or even 25,000, the higher risk allocation is usually okay. But you can see that they never go above 50% normally, and when the VIX is low in the teens, 10 to 15, they go down as low as 25%. So this is, again, just so you don't blow up your account. If the VIX is low, it has a tendency to spike. On those spikes, your buying power reduction is going to expand. And if you don't have the capital or the cash in your account, then you're going to get margin calls and have to get out of trades when you don't want to, when they're at a loss. So now that we have the tastytrade mechanics and kind of the basics down, let's go over a annualized return calculation. This is just based on historical data, and it's not a for sure guarantee of a return, so keep that in mind when we go through this. So for this calculation, we're going to assume a $100,000 account. The average VIX level is around 19. So if we go back to this chart here, you can see, whoops, you can see here that the VIX between 15 and 20, we're going to want about 30% max account allocation. So we're going to use that for our calculation. Average credit, we're going to assume is 15% of the buying power reduction for each strangle. And we're going to assume that each strangle is held for 21 days. So there's 17 trade cycles approximately per year if we assume that one trade lasts 21 days. So based on the 30% of your portfolio for short strangles, that's 30,000 in buying power reduction. We're going to multiply that by 15% to get $4,500 in credit per trade. Times that by 17 trade cycles, and we get about $76,000 in credit per year. So if we take that and we multiply it by the 25% premium capture, we get about a 19% return per year on the overall account of $100,000. And if we up the average credit of 20% of the BPR, then the account return is around 25%. And just for comparison, the average S&P 500, just being passive, is about 10% over the last 100 plus years. So you get anywhere from 2 to 3 times the passive return using the tastytrade mechanics. So like I said, this is just for educational purposes. It's not a guaranteed, but I just want to go through kind of the calculation on how much you can expect to make each year using the tastytrade mechanics. If you have any questions, please leave them in the comments below, and hit the like button and subscribe. And thanks for watching.